what I have to say. This is our quarterly market update and outlook call. We're going to be hosting tomorrow evening in Hebrew, for those of you who understand, at the same time by my colleague Shmuel Ben-Ari, who will be a little bit more focused on the local market. We hope that you enjoy this Zoom format. One of the positive consequences of Corona has been the convenience of speaking to large amounts of clients in this way, so we can get a consistent message. Just for your information, this will be recorded and it will be available on our YouTube channel as with previous webinars. It's also been broadcast live on Facebook, which makes for easy sharing if you feel that it's relevant. Okay, I'm going to start with a summary in case my presentation is a little bit boring, a little bit technical. So I want the key message to just come across nice and clear. And hold on, let me just change slides. There we go. All right, in a snapshot view, bonds, conservative bonds, bad, equities, good. The more your mandate was aggressive, the more equities in your mandate, especially a global mandate, the better you did insofar in 2021. Conservative mandates struggled because conservative bonds struggled. I'll go into that. Our outlook in December was constructive of risk assets, and we had a new administration in the White House. So in December, we articulated a view that we were constructive on risk assets. We had a new administration in the White House. We had lots of government support for the economy, for the financial markets. We had the vaccine, and Corona in December was sort of one thing as opposed to what it is now, which seems to be several different pieces around the board. So we were constructive on risk assets. We thought interest rates were going to remain relatively low. So on the equity side and the risk asset side, we were correct. In fact, we were positively surprised by just how much risk assets performed, and I'll show you in a second. But the problem was the bonds. So again, if you have a conservative mandate, you're going to have conservative bonds in your portfolio, and therefore you're going to be somewhat disappointed with your first 6 months performance. Not terrible, really not terrible. You should still be in positive territory, and it gets back down to setting the right expectation, what an investor can earn from a conservative mandate. Our outlook now is a little bit more cautious than it was in December. What's the main reason for that is inflation. And I will go into this in a bit more detail. It's a complex conversation, and more complex is what will be the Federal Reserve response to inflation. Will they aggressively control it? Will they let it run? These are things we're unable to predict. Okay. What does it mean? What does an asset allocator or an asset manager like ourselves do when you don't have a high conviction view on something? You stick with your strategic asset allocation. We're fully invested in equities. We're fully invested in our conservative bonds. We're fully invested in our risky bonds. And we're sticking to that strategy because the harder it is to time the market, the less likely you're going to get it right. Just because that there's this big thing called inflation hanging over our heads doesn't mean we should sell all our risky assets and wait till we have that high conviction view, because that means you'll sit in cash for an extended period of time. There's always going to be a reason why not to invest, and or some scary reason why not to invest, but we're going to stick to our strategic asset allocation view. I'll share with you some of the ideas that we're tweaking and being just a little bit tactical, but one thing I've learned in this business is that there's always something to scare you for not being invested, and strategic asset allocation works. You're not trying to time the market. You're trying to be invested in different asset classes with different risk profiles to achieve your long-term investment aims. That I can say with absolute confidence. Okay, so that's my summary. Now let's drill down into a little bit more detail. So here we have a summary of some major indices which I chose. We've got three columns. One is year to date. I know it's a lot of data, but I'll talk you through it. Year to date till the Friday of last week, from the beginning of January last year till Friday of last week, and then the last 3 years. And then the last column on the right, you can see some pretty big numbers. And this is what's contributing to everybody's feeling that there's a bubble in equities or the equity markets are overcooked, et cetera, et cetera. And I'm gonna address that later on. But let's first see where we're at year to date to see where the performance in our portfolios is coming from. So S&P 500 US market is done exceptionally well, 16% for 6 months. That means 32% for 12 months annualized. It's a very high number, okay? So yes, we thought at the beginning of the year that the environment is supportive of risk assets, but this is a big positive surprise. NASDAQ is associated with growth companies. I'm going to show you a little bit later how NASDAQ has changed over the years, but you can see that NASDAQ is not far behind the S&P. And one of the narratives of 2021 was this switch from growth stocks to value stocks. So value stocks are better quality, growth are more reliant on future earnings. And it was one of the themes that was talked about, and we even tried to play it a little bit. We bought some more value stuff in our portfolios, but you can see that this gap is not too big between NASDAQ and S&P. MSCI World, that is roughly 50% USA, 50% the rest of the world. It's at 12%. Tel Aviv 125, the main Tel Aviv index, is at 10%. That's in shekels. Interestingly, China has had a pretty tough year. It's only minus 2%. The technology stocks in China, which we hold, had an even worse time. And this is kind of interesting. It doesn't bother me in the slightest. For me, China is a long-term holding. I can't imagine a global portfolio without China. I think that everyone has to have China in the portfolio. We know it's going to be volatile, but we know it absolutely belongs in the portfolio, and that's a long-term play. One of the interesting dynamics that have emerged is the correlation between Chinese equities and any other equity, other emerging market countries, and especially the USA, has come down. Here, this year, it's actually even a negative correlation, but the bottom line is it's come down significantly. So having Chinese stocks in a portfolio, not only are you playing the story that China is going to be a world player in the future, but it also adds some diversification benefits, which reduces your overall risk. So yeah, China was a detractor for performance in our portfolios, but again, it's a long-term play, and we're keeping it. I'm convinced that China belongs in the portfolio. The next index is your global investment grade bond index, minus 2.6%, which is quite a lot for that index. It reflects what happened in March. Remember, with bonds, there's 3 primary risks. One is liquidity. That means your ability to sell the bond. 2, the credit risk, which is the ability of the company to pay you back the money you lent them. And number 3 is duration risk, which is your interest rate sensitivity. A bond is a series of cash flows. You discount those cash flows back at an interest rate. Interest rates go up, bond price down. So in March this year, we had a spike in the 10-year dollar interest rate from 0.7 to 1.7, which is huge. It's a huge spike, and it surprised most market participants, if not all. Interestingly, late June and July, we've seen a reversal of some of that. So the 10-year has gone from 1.7 all the way down to 1.2 about. So we've seen some of that come back. And again, these numbers are to the 16th of July, so they already reflect some of that recovery. Treasury bonds, again, why do you hold treasuries? Treasuries are your classic hedge against equity sell-off. Normally, one of the few correlations that you can rely on in managing money is that when equities sell off and go down, your treasury bonds and your dollar goes up. Those are pretty reliable correlations. That's why we hold treasuries, particularly in conservative portfolios, to try to balance the risk where the client asks us to be conservative. So we hold treasury bonds, and we suffered this year because of the spike in interest rates. Debatable whether it belongs. Traditional asset allocators still believe that treasuries absolutely belong in portfolios. I get it. Not all clients are going to appreciate holding low yielding bonds, but think about it as an insurance policy. The same as you buy an insurance policy on your car or your house. That's why you own treasury bonds in a portfolio. Interestingly, gold is negative year to date. In a year when inflation is the story, this again proves what I've been saying about gold over the years, that the link between inflation and gold is not what it was in the 1970s. I think that link is broken down. Yes, if you've held gold over the last 3 years, from 2 years before Corona, you would have made 35% according to this table, but that doesn't mean that response was necessarily an inflation linkage. People think inflation and gold go together, but in my opinion, they do not. So gold was definitely not a place you wanted to be in 2021. Just referring to the local bond market, for those of you who have shekel portfolios, which are separate from dollar portfolios, you might be surprised to see that your shekel portfolio, for the same conservative risk mandate, has outperformed your dollar portfolio. And it's because Israeli corporate bonds have actually had a very good year. And this index is 4.3%. I know that our portfolios have done a little bit better even. And that's a delayed recovery. Israel, the local market, was a little bit slower to get the confidence back post-Corona than the US market was. So it was a little bit behind last year and a little bit ahead this year on the Israeli corporate bond side. Hedge funds, this is a liquid benchmark. There are many benchmarks for hedge funds. This particular benchmark at plus 2.5 shows that many hedge funds are struggling. I'm pleased to say that the select number of hedge funds we use in hedge fund mandates have done a lot better than that. So that's the broad index view. I think I forgot to say in the introduction, if you want to post a question, please just write it in the Q&A. There's more people on this webinar than we've ever had before. So I'm not sure I'll be able to answer all the questions, but I will certainly try. Key themes for 2021. I touched on this in my intro. COVID variants. I don't want to talk too long about COVID. I don't want to speculate too much about it. All I can say is that this is the new normal. Corona is here to stay. If a year ago I thought that I would still be talking about Corona in July 2021, I've probably been much more conservative in our outlook for 2020. By now we thought it would be gone, but it's here to stay and it's mutating into different variants and we're adapting, but life goes on. These variants appear to be highly contagious, less dangerous in the vaccinated world, more dangerous in the unvaccinated third world. And we're just going to have to get used to it. And as you know, and as you've experienced, people are traveling again. Okay, different countries are different. There are people on this call from different parts of the world, but certainly in Israel, which is amongst the better countries from a COVID point of view, people are traveling, things are happening, and this is the new normal. So we're getting used to it. That's linked to the next point, reopening around the world, etc., etc. It seems to me that the first world is just moved on and we're getting used to living with Corona. Inflation, I'm going to talk about in a bit more detail now. It's a big deal. Government policy, the withdrawal of the stimulus that they had in the past. This is a big deal, especially as it relates to inflation. Rising interest rates. Our outlook at the beginning of the year, we thought that interest rates would remain low. We were surprised by the spike, and now they seem to be coming back down again. Debatable. Many people think that interest rates will continue to increase. But this remains a risk in the portfolios. And a lot of the guys that I follow are saying that interest rates should approach 2% by the end of the year. It doesn't look like it. I think that, but somewhere between where we are currently, 1.2 and 2%, I think that's where we will finish the year. Social unrest. From the beginning of Corona, we said that social unrest would be a consequence of the unemployment, the government support, the asset inflation, where the rich are getting richer and the poor are getting poorer. South Africa, unfortunately, heartbreaking, but suffered this last week. It's a complex story. I don't want to go into it. Brazil, other countries, Turkey, other countries have had social unrest. Certainly, it's going to be a challenge for political leaders around the world. Okay, inflation. We're seeing some funny data coming out in inflation, okay? And when you think about inflation, governments are issuing one number to represent what's going on. And that reminds me of the story of the guy who puts his head in the oven and his feet in the fridge, and then on average, he's in room temperature. Inflation's a bit like that. We've got certain things that we buy where the prices have gone up sky high, 20, 30%, whereas other things that we buy actually got some deflationary forces at work. So, and a lot of those things that have shown really high inflation, there's some supply side constraints. So go back a year. Last year, energy prices were really low. Companies cut, and other commodities especially, companies cut back their outlook for 2021. 2021 comes, we've got a huge boom around the world, and we have a shortage on many, many things. So there's supply constraints. When this normalizes, we think prices will normalize, but we've got some really funny data coming out. And so the economists that I follow, some of them are scratching their heads and they're saying, well, we're just not sure where this is going to end up. Even Biden yesterday spoke about inflation, and he said, don't worry, this is temporary. These numbers that you see are temporary, very high inflation numbers. It's difficult to discern the data. It's difficult to figure it out. There's another effect. For example, inflation is generally regarded as a negative, okay? It is a negative. It destroys your purchasing power going forward. However, if inflation is coming out of housing prices, so for example, in the US, housing prices have gone up considerably, but housing prices going up, it actually has a wealth creation effect, not a broad wealth creation effect. You have to own the house in the first place. So you have this wealth creation thing going, which is asset inflation, which makes the rich richer and their spending power increases. So it's not necessarily a negative. And that's one of the contributors to inflation and housing prices in the US. So really, really not clear picture on inflation. And as I said, not clear what the government, the Fed policy response will be. One thing that is clear, okay, is that the trend is higher. We have to get used to higher inflation going forward than we had in the past. If that inflation is only moderately higher, slightly higher, say 3% instead of 2%, or in the past it's been 1%, then I think that that's going to be supportive of risk assets. I think that that's a good thing. But too much inflation is definitely a bad thing. So what is the ideal inflation rate? Federal Reserve has said, you might have read about it, they said they have this target of 2%, but they haven't clarified how they calculate. Is this a long-term average? Are they going to let inflation run ahead of itself for a while? I think central banks have a motivation to let inflation run ahead of itself. Firstly, they need to catch up for the 10 years or so that they were running under 2%, so they need to catch up. And two, they know that the only way governments are going to repay their high levels of debt is to inflate the whole economy over time. So they're quite happy if inflation overruns for a little bit. They'll look at other factors like the job market and the employment and things like that, but they'll let inflation overrun. If it goes too far, if inflation goes into the high single digits, even above 5, then they're going to need to apply brakes to the economy. How does they apply brakes? They increase short-term interest rates quickly, and they start selling some of the bonds that they bought in the past, and that increases long-term interest rates. That's basically engineering a recession, okay? So that would be bad. If inflation runs away and exceeds the expectations of market participants and the Fed, then that's a scenario which I think will be negative for risk assets. Okay, what do I expect? I expect that inflation will stabilize at higher numbers than what we're used to, but I don't think we're going to reach the point where the Fed has to completely engineer a recession. I do agree with the point that many of these funny numbers that we're seeing are temporary and not real, and we're going to settle down to just a higher number. Yes, interest rates will increase. Okay, we're not going to stay forever at 0.25 or 0 on dollars. So interest rates will come up, but hopefully it'll be in a slow, staggered, sensible way with lots of communication with the market and not a panic hitting the brakes hard, because that would be bad. Okay. The next question I get asked more often than how are you is there a bubble in the equity market? Okay. Now, the point I want to make here is you can't, let's just say one valuation metric that is used is price earnings multiple, which is not a very reliable, it's certainly not something that you can trade, but it's a fact, it's a number. So let's just say, for argument's sake, the price earnings multiple of the S&P today is 30, okay, which is a relatively high number. But you can't compare the price earnings multiple of 30 on the S&P today with say 10 years ago, because of where interest rates are. We're in a world of negative real interest rates. So that means nominal interest rates minus inflation are negative. That means in order to protect your purchasing power of your money, you have to invest in risk assets. You have to invest in something that's going to give you a return, because otherwise your purchasing power is going to go down over time, and you can't earn money through interest to cover that. So you have to buy equities. So this is the new normal, and therefore higher multiples and a broad, higher, more expensive market, I think we're just going to have to get used to until interest rates and inflation normalize. So yes, the market is high. There's no doubt about it. Is it a bubble? I would say no, because of where real interest rates are. Okay. The market is pricing in what I said about normalized, stable inflation without a Fed aggressive pullback. So again, valuations are frothy. The market is high, no doubt. But I don't believe there is a broad market bubble. That doesn't mean the market can't go down. Yesterday, the market went down 1.5%. Alarm bells started going off in the world saying, I told you so. I told you. 1.5% is nothing. It's just one day's volatility. It's really nothing to get concerned about. And it's certainly nothing that should change any strategic direction. Within that, having said that, there are certain sectors which I think are bubbles, okay? I think the IPO world, I think the SPAC listing, which is another way of listing a company, I think that world is overvalued. These are the, and funny enough, there's an Israel impact here, because a lot of Israeli companies have been listing and they're trading at insane valuations with no profit, or all they got is growth. So I think these companies, and Pioneer, we don't really invest in these type of companies. We don't invest, not don't really invest. So I think that these companies have got unsustainable valuations. There will be some damage there. Some of them will be okay if they deliver the goods and the growth which the market expects, but certainly not all of them. So that world, I think, is a bubble. There's no way to justify some of those valuations that are in the market. But it seems that at least Israel and some of the entrepreneurs here are benefiting, so we'll let them enjoy that. Okay, so I hope that answers the question of, is there a bubble in the equity market? Let's just have a look here of how the main indices, the S&P and the NASDAQ, are made up, okay? We often talk about the S&P and NASDAQ as much more diversified than they've become. So if you look at here, I've got the 7 largest constituents of both the S&P and the NASDAQ. You can see the overlap. So the third column here is the weighting within NASDAQ. And what it shows is that 50-something% of the NASDAQ 100 composite, 50-something% is 6 companies, okay? Apple, $2.4 trillion market cap. Microsoft, $2 trillion. Amazon, $1.8 trillion. These are bigger than many countries. So these absolute monsters are so huge. When we buy the NASDAQ, that's why I say it's less growth orientated than one would think. If you look at the PE multiple here, which is the second column, Apple, a 33 multiple, that's expensive, all other things equal. But as I say, negative interest rates, inflation on the horizon, it can make sense that it can trade at such a high multiple. Amazon's always traded at a high multiple. If you were scared of valuations, you never, ever, ever would have bought Amazon throughout its journey since 1997. Google, 42, and of course, Tesla at 147. So obviously, Tesla has to deliver a hell of a lot of profit to justify its size and position in the market. Yes, there's going to be some volatility purely from the Tesla component. But the point I want to make here is that NASDAQ is got these monsters, and I think that these monsters are more quality companies than growth companies. When you think of NASDAQ, you think of these technology companies that are trading, that are all, all stories or whatever. But you can see that they're made up of the monsters. They're less of an issue in the S&P 500. It's still 20% of the S&P 500 is these names. And you can just see on the right hand here, the last column, how much these names have grown over the last few years. So I thought that was an interesting point to make. Okay, so let's just summarize some of the points. Are growth expectations too bullish? It depends on the inflation question. If inflation is contained without any major pullback, then I think that a post-COVID rebound will continue for a while, and we will enjoy some some real growth still to come. But it depends on this inflation question, which we're not sure how it's going to go out. COVID variants, I don't think, yes, they're scary. Yes, the numbers are high. I can't see a full shutdown and going back. The public is dead against it. And unless the fatalities start really piling up, then the governments will just let it run like they did in England. So in England, you have a very, very high number of case counts, not too many serious or fatal cases, thank God. But bottom line, I don't think the COVID variants are a major market mover. I hope I'm right. Okay, pre-COVID, what we used to say to clients is that the bond market is low, and therefore one needs to be realistic about future returns from that. COVID came, it actually gave investors a bit of a boost. Post-COVID, we're saying, okay, the bond market is where it's at, meaning it's going to give you low returns. Doesn't matter who your asset manager is, whether you manage your money yourself, or you use Pioneer, or you use Goldman Sachs, it doesn't matter. Bonds do not give interesting returns, full stop. Therefore, more money is going into alternative investments. Pioneer, we've placed more money in alternative investments this year than ever before. Alternatives mean different risk profiles. You have to get used to different complexity. It's not just a case of market volatility. There's complexity in alternative investments. There's a whole lot of compliance rules about who we can offer alternative investments to and who we can't. We do offer clients the ability, clients who don't meet the qualified client declaration, we do offer them the ability to give Pioneer discretion, where we will buy some alternatives on our own discretion without making an offer. Otherwise, you do need to be a qualified client in Israel to be offered alternative investments. I'm not going to comment about other jurisdictions. There are people on this call from other jurisdictions. Okay. Again, we cannot predict the Fed policy and inflation risk. Therefore, we're going to stick to our strategic asset allocation, be fully invested in equities, nicely diversified, globally diversified. Yes, with our China allocation, we're going to stick to our bond allocation. One of the questions in the registration process for this webinar is where we think the shekel dollar is going to be. I hate predicting currencies, but I instinctively feel that the shekel dollar is going to remain in a narrow range in the short term. There are a lot of good reasons why the shekel should be stronger, and there are a lot of good reasons why the dollar will be weaker, okay, should be weaker, which would push that rate down to the 3.1 or even the 3s. But there's Israeli central bank intervention in the market, and they are the biggest trader of this shekel dollar currency, and they're intervening and interfering. And therefore, it's quite difficult to predict. So I instinctively think that it's going to remain in a narrow range and not jump any major surprises there. But again, predicting currencies is not an easy thing to do. So some of the ideas and some of the conversations we're having with clients, if the returns available in conservative bonds are not enough for you, you have two choices. You need to increase risk either by going the alternative investment route or you go additional equities. Now you say to yourself, hold on a second, but you said equity market is high. Why would I increase equities in a high market? And the logic there is to use an inflation lens. If gold's not going to work to protect you from inflation, bonds certainly aren't going to work to protect you from inflation. And if inflation is going to come, then what you want is more and more quality companies like Apple, like Google, like Microsoft. These are the companies you want in your portfolio because these are the companies that will adapt to higher prices, and you should get some purchasing power protection from that process. EM bonds, there's more return in EM bonds than there is in developed market bonds. EM means emerging market. Alternatives in the portfolio, as I said, we believe in that. Europe, on a valuation basis, Europe is attractive. There's many reasons why Europe is a bad idea, but we've started to buy Europe purely on the valuation point of view because, there's a big difference between European valuations and USA valuations. On China, be patient. As I said, it belongs in the portfolio. It's going to be volatile, but I'm convinced that it belongs. USA, be long-term. There are a lot of people who are negative on the USA or the level of the market. America is still the strongest economy in the world by far. The dollar is still the strongest currency in the world by far. It's still the reserve currency of the world. If the world is going to face any sort of trouble, you'd rather be in the USA than anywhere else. So you got to think long term. Yes, it'll adapt. We may have sell-offs, but the USA has shown its resilience to make money and show good companies and good growth companies time and time again. So that still is valid. Bonds, if you decide that you're a conservative investor, you don't want the complexity of alternative investment, you don't want to buy more equities, then just have realistic expectations about what sort of returns you can receive going forward. Alternatives. Let me just remind you the types of alternatives. Again, there's some compliance story here. Not all clients can buy, not all jurisdictions, etc. Secured lending, where you become the bank, you lend to someone with some sort of collateral. Unsecured lending, these are typically via a technology platform that makes peer-to-peer lending, where buyers and sellers meet on a technology platform. You invest, highly diversified, average loan size is small. These type of things, your security doesn't come from collateral. Your security comes from the fact that there's thousands and thousands of borrowers inside there. Hedge funds, historically, we've been a little bit negative on hedge funds. They're expensive. I showed you that one index that's definitely not impressive year to date, but we're quite happy with our hedge funds. And I think in today's environment, adding hedge funds is not necessarily a bad idea, especially if the market, if the tide does go out. Hedge funds have shown a little bit more resilience on the downside. They will not keep up. If the market runs, hedge funds will underperform, in my opinion. But they have shown some value on the downside. Structured notes, I really like structured notes. There's a webinar on it if you want to watch it. The market for structured notes is a little bit tougher than it was last year, but still there is some opportunity there. And again, property. Everybody needs property in their portfolio, whether it's your house, whether it's an investment property, whether it's a property fund, or properties have leverage, they have other things. So these are the type of alternatives. We have some property solutions that we're buying for clients on a discretionary basis, which have liquidity. And of course, we have traditional property that has no liquidity. So those are alternatives. That's where we think more money will be made going forward than in the bond market. And clients should think about that. Okay, I hope that's about 35 minutes, not too bad. Let's have a look at some of those questions. All right, so the structured notes I just dealt with. I got a question here. Do we see Chinese intervention and fines in their companies to continue, i.e. Alibaba and friends? Is this market to invest in? Yeah, so this question is, there's been a lot of negative press about China. China's trying to stop some of their good companies from listing on global exchanges. They want them to list on their local exchange. The government feels that they need to control these companies. This is the reality of investing in China. As I say, China has its volatile holding, but I think it belongs in the portfolio. One of my main motivators is Chinese market is hugely underrepresented in the MSCI World Index. Okay, the MSCI World Index is made up of all different countries, but China is a thin slice there, whereas the actual size of the Chinese market is significantly higher. And as that becomes, over time, as China becomes more integrated in global markets, I think it's going to play a greater and greater and greater role. The economy is growing and growing and growing, and therefore it belongs in the portfolio. Will I buy it 1-to-1 with the US? Absolutely not. If we've got 20% in the US stock market, we'll probably have 4% in China. It's not 1-to-1, but it belongs in the portfolio because I think in the long term it should prove itself. We received a number of questions in the registration process, which I'll try to deal with. How do we see the outlook for USD investments relative to shekel investments, taking into account both currency and tax? So for those who don't know, if you're a new immigrant to Israel, you don't pay tax for 10 years on your global investments, but you would pay on your shekel investments. So your shekel investments are taxable. There is an advantage. The local shekel bond market is offering a little bit more juice than the dollar market for equivalent risk. However, the tax is a factor, but I think that this question is a holistic financial planning question. Everybody needs to look at how many assets they have in different currencies. If you live in Israel, you need a certain amount of money in shekels, invested in shekels for the long term, because you don't know what the exchange rate is going to be. So I would say that the premium for shekel bonds over dollar bonds and the tax are trivial compared to your currency risk that you may have on a holistic level. So each investor needs to decide with his financial advisor what percentage of his investments. And again, you don't want to have the tax tail wag the dog. All right. Tax is not a strategy. Tax, you should have your investment strategy, and then you should optimize that for tax purposes, not the other way around. So that question leads me to believe that somebody's thinking more about the tax benefit and the yield pickup rather than the holistic reasons for why you want some of your money in shekels. Can we give an indication of the outlook US dollar shekel? I mentioned that. Which sector rising is not reflected its real value? So I said the sectors that concern me is these new IPOs and the aggressive end of the technology spectrum. All other sectors on an objective basis are expensive. It's not like there's one sector that looks cheap. Everything looks expensive, but again, we have to be realistic. We're in a negative real interest rate environment. There's a tax question here, which I prefer not to deal with in this forum. Bubble in equity. So I think I addressed the bubble in equity question. Okay, so there's a few more new questions. What is the view on real estate holdings, especially malls, etc.? So it depends where, which country you're talking about. Most of our real estate exposure is in the USA, and where the retail market is, if you're in malls and retail, then I hope you were in really good stuff, because they took a lot of strain through Corona. The cap rates on property are not very attractive from a stabilized point of view. Obviously, there's opportunities if there's a good property manager who knows how to extract that value and improve the outcome. As it is, the primary benefit of a low-risk property project versus a bond is the property has leverage. So if all goes well and they manage the risks, then you're going to have a higher return in your property than you would in your bonds. But you've got no liquidity and other disadvantages. So I'm not sure if that answered the question. Do we do a custom portfolio for £250,000? Unfortunately, we don't do a custom portfolio, but there's nothing wrong with our model portfolio for that type of money. If you could reach out to the financial advisor who you know, or via the general email here, we'll be in touch with you and we will talk to you about it in a bit more detail. Okay, I think I answered all the questions. Less questions than I expected, but I hope you found that informative and useful. I welcome your feedback. Please stay safe and stay healthy, and we will see you on our next webinar. Thank you very much.